We have a Federal Reserve saying pain is coming, and more CEOs are basically saying in order, the price slash cost of beating inflation is higher unemployment. I think that's a pretty direct correlation. It's kind of leads to demand destruction. I'm just curious if you see it the same way, and if so, any thoughts on how much or where we might go in this with this unemployment rate currently at 3.5%.
It's the only thing they have. The Fed cannot address inflation any other way. They can't increase supply. I mean, they're not making anything. They're not manufacturing anything. You have to make the cost of capital and the cost of doing business more punitive to slow demand down and to get prices down. And so how do you get prices down? If you think about where prices are and why, a lot of it is labor. I mean, some of the most stickiest aspects of inflation are in the service sector, which is based on labor. Cost to manufacture goods is going up. We have supply chain issues still that haven't 100% been resolved. But when they do get resolved, what everybody has learned in business over the last couple of years is we can make less and charge more. So why should we change that? So you're going to see commodities like lumber and copper and steel and things like that that'll, they're coming down, but energy's going up. How are you going to fix that? How's labor going to fix an energy problem? It's not.
Yeah,
that's a supply problem. That the only way to fix that is you got to produce more energy in your country, and it's not going to come from the sun or from the wind or any of that at scale on demand. It's going to come from us, cultivating our own natural resources or building our own nuclear program, and getting back on that again, if in a way that's safe and good for the environment and all that. When you think about the cost of other products that are coming in, those are the things that aren't coming down, where you have individual manufacturers that are in charge of that market. So if you're making something with these other natural resources that are coming down and you've been charging a premium, you're not going to drop your prices because you're, like automobiles, right? So they're coming down a little bit, but in general, the manufacturers have cut back. They're making fewer cars. They're charging more. Why should they change that? They're profitable finally. So the question is, how far do you need to contract in order to actually start correcting the labor market? And I don't think we're anywhere near there, because it's still so strong. There's still so much demand, especially in the construction industry and trades industries and the service industry. People can't get help. So there's so much distortion out there that needs to come back into balance before you can even affect to the negative side to start really affecting, pricing. I don't even know that that'll work.
Yeah, it's such an interesting job market. Obviously, we have this thing called the JOLTS report that basically highlights job openings versus, available resources. It peaked at almost 2 to 1. It's now at like 1.6 to 1. So it's coming down. We had 1 million job openings vanish, but we're still at 1.6 openings per unemployed. Crazy strong job market. I agree with you. Something that I'm coming to believe, it'll be interesting to see what happens in tech this week, because we've got a lot of big earnings, is I think we're on the cusp of a white collar recession, not a blue collar, not a trade recession. I think there's been a lot of distortion over the last decade or so, kind of go to school, go to college, get a degree, go get a white collar job. And, I think it was Altimeter just released a open letter to Facebook or Meta, basically saying whack 20%, you're bloated. So I think there's a lot of companies that, may have some layoffs. I think the big layoffs are coming in tech and finance, right? You heard Jamie Dimon talk about making record profit on $1.3 trillion in cash. All he does is wheel the money over to the Fed. The Fed pays him 3% interest or 3.05 for overnight. And he's like, that's easy money. I don't need a lot of traders for that. So I think there's a lot of pain coming to tech and finance. What do you think about that?
Yeah, they're both bloated because of, what's been happening lately, and they're starting to cut back. I mean, Elon Musk said, hey, if I buy Twitter, I'm going to cut 70% of the jobs, because they have an unbelievable amount of people. So I think, and there's a lot of duplicity in the process, especially in the jobs reports too, because I'm wondering, how accurate is that? They might be even double counting some of the openings because of remote work. Some of the openings can be, advertised multiple ways. Yeah. So, what's the real situation out there? But what I can tell you, again, I work with entrepreneurs, investors, people all around the world that are employing people in their businesses. And most everybody I know cannot get help. It's very, very difficult in every sector. So until you get that in line and you get that corrected, you're not going to see demand destruction from that standpoint to where manufacturers have to start, laying people off and cutting back at scale. Again, a lot of the tech sectors, a lot of that, and those people can get absorbed in other industries, right?
Sure.
So we'll see what happens there and how that really affects it. What's really going on, this is what the Fed is doing, and this is what people need to get and understand. The only way they can really destroy demand is to make you feel less wealthy. So that's why they want damage in the stock market. They're not happy with what's happened the last few days. When markets rally, the Fed's not happy. They want housing to come down. Why? Because people were tapping equity and using that money to pump into the economy and spend. Again, we're consumption driven. So if you've got a fat 401k, you feel safe, you feel like you can spend. If you've got equity in your house or you've tapped that, you've got all those resources to spend. If you have available credit and you have money stacked up because you haven't been traveling and spending, during the last 2 years of the, lockdown and pandemic and all that, that was built up, people have that. And just like the stickiness in the housing market, the stickiness everywhere else is out there. People feel like this easy money train over the last couple of years is going to continue, especially people that, like millennials that have never experienced anything like a 2009. All they know is up. So they don't understand where we really are, how long this can really last, and what it means to delay gratification and, put some savings away and store up, not at scale, but a lot of people, that's a lot of what's been going on. So people haven't hit that mindset yet where it's like, uh-oh, we better cut back. People are still spending, they're still eating out, they're still doing things. It's really interesting what's going on out there in the mindset of people right now, because everything's been so good for so long. Everything's been growing at scale so long without inflation. That's what's pretty wild, is that we didn't really get inflation until the pandemic. But the labor market was getting tougher and tougher and tougher, and housing was going up. But again, it was all interest rate driven. And, that's what creates all that leverage that goes into the system that makes everybody think, I have all this, I can just go borrow. I can just leverage this. I can, my stocks are going up. My crypto has been on a tear. A lot of money was generated in crypto that has been pumped in the economy. So all this is contracting now, but it still hasn't caught up. And we've got the holidays coming. So there's, people are going to be spending. And, I think Q1 next year is when everything's going to come home to roost, and it'll be a rude awakening with energy prices and, everything that's going up. And Christmas this year, with the prices people are going to be seeing and spending reserves on to get through the holidays. I think Q1 next year is going to be pretty interesting.
Yeah, we'll kind of close on this topic. Really, what I see the Fed doing, raising the cost of capital, which makes it harder for companies to perform. We got a lot of zombie companies. I think Michael Burry was talking about, I don't know, like 100 or whatever. The 62 companies are zombies, which means they don't have enough cash flow to pay their debt, so they just borrow more.
Well, that's public companies he's talking about.
Public.
There's thousands of them out there that aren't public.
Good point. Great point. You're absolutely right. And again, when you raise cost of capital, you make it harder to borrow. They have to lay off or shut down or get sold for pennies on the dollar. So I think what's going to happen, again, raise rates, unemployment eventually ticks up. Bankruptcies or liquidations or whatever you call it ticks up. Ultimately, that's got to hit GDP, right? So do you think we have to have a recession in 2023 as kind of the outcome of all this, of extracting, making people feel less wealthy, i.e. the negative wealth effect?
Yeah, I mean, I think a recession is definitely baked in. The question is how deep and how long. But you have to. I mean, recession is a slowdown, so you have to have a slowdown to get prices in check. Because again, they're just not going to come down on their own until something happens. And the likelihood of a financial accident in the bond market, in the credit markets, something like that, creating a systemic risk can happen where the Fed may have to inject. And that's the whole thing, is that be careful what you wish for. So the markets want the Fed to pivot. If the Fed has to pivot, look out.
That's not good.
Some bad stuff happening. And, it's only going to be temporary, because they can only do so much so long. Because again, look at inflation and, just look at politics, regardless of which side of the aisle you're on. Abortion was the number one thing swaying political divide in the country. Now it's inflation. It's threat to democracy. If inflation and, abortion is coming in a little bit lower now, but inflation, that's a real thing. When people cannot put food on the table, man, you got problems in a democracy, in a country. And, people are rising up because of it. That's become the number one issue out there on the table right now, threats to democracy and inflation. So it'll be really interesting. On the topic of businesses and taking them over, maybe we'll do something on that. We'll tell you how to buy a business with no money at all out of your pocket, because there are going to be some opportunities coming up here soon.
I like it. Greg, where can people find you?
GregDickerson.com. Go check it out.
Thank you, buddy.